Okay, hello, good morning. Hello, Jatis. Hello, rest of the people of this room. We are Max, Marcelo, and Miguel. And some years ago, we formed Triple M Consulting Group. So today we are going to explain you some ideas for Dollarama. Let's go. So the presentation outline, we are going to follow the challenge, the analyze, options. That's it. So, first of all, for the challenge, what we want. We want to maintain the quality of the products we have, but continue the profitability in a long term, okay? For long term way. Follow? So, the strength we have is the direct buying, okay? The weaknesses is the low margin we have with the product. Low price, low margin. That's a little weaknesses, it's not a big problem. The threat is the increased cost. The costs are increasing, and if they increase, the price will increase. And the opportunity is that with the crisis, people won't buy products with low cost. So we have an increasing market. So our alternative, we are thinking the labor cost. If the cost of the products are increasing, we are thinking reduce labor cost. Why? So how we are going to do that? We can restructure management and warehouse business. And we can do that by introduce warehouse automation and management restructuring. We think it's not a really good idea because we are good in these places and are not a big part of the business. But so we have thinking invest in retail technologies. There are some machines that our customers came to the place, buy, and you don't need the employees to attend her or him. They just buy by themselves. So we think that it can be a really good idea to reduce the cost of the employees. So not only that, but also we have think in our supplies stability. It means that we have think in diversification. I mean more suppliers, not just one, but also more, and invest in our products. We think that our products is not a good idea because in our criteria we are thinking a low risk. We don't want risk for the company, and start working with the production have a lot of risks. You have to buy machines, you have to buy lots of things, so it's more risky than buying the products. So we think it's not a good idea. But the diversification, we think is a very, very good idea because if we have more companies, we are not going to depend if one of that companies want to sell at one price or another. We can go for the other one. So now Max is going to continue with display.
So the third vulnerability that we've identified is financial vulnerability. And what we want to do is we want to try and make sure that the business has a strong financial basis. There was the high leverage buyout a couple of years ago, and because of this there's a high amount of debt. So what we want to do is we want to increase margins and maintain the high cash flow. We plan to do this through two techniques. Firstly, the increasing of the home brands, and then the reducing of the inventory days, which is quite large. Then an option we considered was reducing debt by further public offering, but we decided against this because taking the long-term perspective, we've decided the other options would be most appropriate. Could go to the next. So to start off with, I'll take you through the proposals for the labour costs. As Miguel outlined previously, we're going to focus on the retail costs. So these are the most significant with the 12,000 odd retail staff. We decided to implement a system such as self-checkout machines. Basically, the plan for this is that for the checkouts, we'll introduce, to start with, in our new stores, we'll introduce 2 self-checkout machines. What these do is they reduce the amount of employees required in the checkout business. We've done the sums and we'll take you through them later. But the aim will be to implement them at the beginning of the lifestyle cycle of the stores. So the stores have an 11-year lease. Because they are an investment, they cost $31,000 per unit. We're going to time them out over the 11 years of the stores. And then, so that will be the implementation. We've found out that there will be significant costs in the cost reductions in the long term, and we've also noted that around the world these have been implemented in various contexts, and for the first 6 months or so there have been a little bit of resistance by the customers, but then once they've come to terms with the technology and once they have an understanding of how it works, there's been a positive embracing of it. So we believe it's going to be a good fit for our stores. Go next. This is an example if you haven't seen it. Basically, there's just a touch screen, you scan it yourself, you bag it yourself, and you go along. There's still required to be a personnel in the area in case there are any issues. But basically, it speeds up the process, and it will save costs long term. So the second proposal is relating to supply vulnerabilities. Well, we've noted that there has been some vulnerabilities with regards to how we get our products from the suppliers. So at the moment, the business is quite successful in diversifying their product suppliers, but we're going to continue this. So we're going to find more suppliers, both domestically and internationally. Domestically, it is a bit of an issue because it will be higher to find the low costs, but we feel this will be offset by the risks with regards to currency exchange. For the international, we'll be taking advantage of the networks we currently have, mostly in Asia. If we can go to the next slide. And then with regards to financial vulnerability, to start with, we're going to be looking at higher margins. So at the moment, 52% of the products are home or own brand. We're going to try and increase this up to 60 or 65%. The aim of this is to provide greater control and greater profit margins for the business. We hope that this will provide the business with a bit of a cash barrier and could help with the repayments on the interest. And secondly, we need to reduce the inventory days of stock. At present, Dollarama has the second highest amount of days stock kept in inventory in the industry. And this is due to a couple of factors. Firstly, it's because of the low-risk approach, and also because of there's problems with the suppliers. So, coupling this with our diversification of the suppliers, we hope to reduce risk for that, and therefore this will allow us to reduce the inventory stage. So we won't need as much buffer zone with our new supply system. And then that we won't be using just-in-time methods, but we'll be taking this basis. And we still want a bit of buffer zone to be consistent with the culture of the company, but we're just going to try to reduce this down to the industry norms. And then I'll pass it.
So, with the implementation, what about the self-checkout machines? It's not going to be practical to install them in the shops that we have or the stores we have now. Why? Because in order to these machines be profitable, we need long-term, they have to be in the store for a given amount of time that we're going to talk later. But for this, in average, the contracts of the rental of the stores are 5.5 years. Then what we're going to do, if we start opening new stores as we want, then the contract is going to be for 11 years. So it's going to be really profitable to have a machine that's going to do the checkout for all 11 years than installing those in the stores we have now and then having to move them or most of the times throw to the garbage because it's only for a short term. Then what are we doing? For the first step is installing the self machines in the new stores. Then from 3 to 6 years, that is when most of the current stores are gonna their contract is gonna end. Then we may think about installing these self machine stores in those.